One question here. So again, like the advice to passive investors watching this show, and the kind of the goal of our show is for passive investors. So to go and become so sophisticated that they can fully comprehend a subscription agreement or a PPM, to fully understand what the plans of a GP is, if the GP hasn't been totally open about what the plans are, and sometimes those plans do change. Is it good measuring stick or a litmus test preferred returns? Is it fair to say preferred returns are a great way to evaluate if the GP is putting basically their money where their mouth is? Is that a fair
Absolutely. I love preferred returns. So I started my syndication using a profit split. Right. So I'm sure you guys are aware, right? In my book, I've written this something called profit split.
Please describe it.
There's two types of compensation in the industry. One is where we get a profit split and then we just split, 80-20, 70-30 or whatever we get, we say we split. That's where I started. I came from that mentality. I said, hey, alignment of interest between passive investors, right? But what I realized, I also wrote in that book as well, that one of the bad things about profit split is when the deal goes down the drain, everybody goes down together, right? Right. So now, because the passive investors who are supposed to get at least 6-7% return may not get anything, right? Because now they go together with the sponsor, right? And so it doesn't work very well on a downturn. And during COVID, that's what happened for a lot of people who does profit split. A lot of passive investors didn't get paid, and a lot of sponsors just, okay, I'm not going to pay out, right? When they say no payout, they say both in the same boat, right? Nobody gets paid out, right? So the other structure that I mentioned in the book is called pref return, which is a waterfall structure, right? And the waterfall structure gave an investor a base return, right? 6, 7, 8% base return, which is the first return that we have to give it to passive investors. Then only after that, the GP start taking money of it, right? So past 3 deals that I'm doing, I've moved to pref return structure, because I think there's a lot more advantages for passive investors, and it's a lot more powerful for syndicators, because syndicators now are motivated to do better on the back end. Right. Otherwise, syndicators are not very motivated to do more on the back end or to push the performance. If I'm a 80-20, as I said, I have a lot of deals when I'm doing 80-20, and I always think about even my own thought process. 80-20, okay, so what? If it doesn't work, it doesn't work, right? Both of us are the same boat, I can't. So if I look at a passive investor, now they are like in a disadvantage, right? Yes. For me, during COVID, I can stop payment and nobody's going to say there's nothing accruing, right? But on a pref, it accrues, right? Assuming it's a cumulative pref, right? Yes. So pref accrues. So the passive investors are better protected. So I wouldn't even say alignment of interest. I would have said we were putting passive investor interest first. Then the sponsors are taking money, right? So yeah, so I think pref is very, very powerful. And I think one thing I wrote in the book, which I think, if I write a second revision, I need to correct that, is basically, I said pref return is filled with fees, right? I think if I remember correctly, it's filled with fees, whereas 80-20 is less fees. But it's actually, as I said, I learned a lot even after writing the book, right? I realized that even with 80-20, you can put whatever fees you want, right? You can put all kind of fees. If fees are fees, you as a passive investor need to see whether it's reasonable for a sponsor to take or not. But the structure of how the passive investors are being compensated is very, very key, right? So for me, what I see is pref return is a lot more powerful right now. And I also realized 80-20 people are manipulating 80-20 or profit split a lot. A lot of manipulation happened between syndicators and sponsors. So let me give you some examples of manipulations, right? So people said, not say people said, I like to use the word people, but in general, right? A lot of passive investors or sponsors said, hey, I'm doing 80-20 profit split, or I'm doing 70-30, I'm doing 90-10. But there can be 3 ways how the split happens. First is, they can say this split is a return of capital, right? They really won't talk about a return of capital. And what happened, return of capital or return on capital? Return on capital is basically true profit, right? You're getting a true profit on top of your whatever money that you're investing. If you're putting 100,000, if you get 1,000, is 1% of that 100,000. So your 100,000 is always kept, right? So that's called return on your capital, right? The 1% is on top of 100,000. But if you call return of capital, that $1,000 could be part of that 100,000. So you basically, once I distribute the 1,000, your remaining capital is 99,000.
Which is,
So if you do it, yeah, which if you do that for 5 years, if you do a return of capital for 5 years, let's say if I'm giving 10,000 per year,
Yes.
right? Let's say I'm put 100,000, I'm paying you 10,000, 10,000, 10,000. And the way it's being structured is return of capital, right? So how much you made for the past 5 years? That's a quiz for both of you.
You have made zero.
Yeah, absolutely. You didn't make any money for past 5 years because
yeah.
you have been getting back your own money. It's actually a loan.
Yes.
Right? I mean, only on a loan you get back your capital, right? So
Yes.
it's actually a free ride loan for sponsors, right? So, but on top of the loan, you are basically, I mean, yeah, of course, they said at the sale, you're going to get back your money, right? Because they said, I'm giving back all your capital, and at the sale, I'm going to do an 80-20 profit split. But the whole risk for passive investors has been put at the sale, which is 5 years down the road.
Yeah.
Right. So basically, it's a huge risk for passive investors. They have what the syndicators have done when they do a return of capital structure. They have taken this low risk multifamily investment or any commercial investment. Multifamily is very, very low risk investment, right? If you might buy it right, it's low risk. But because they have done this as a return of capital, they have just by changing one word in the PPM, they have made it a high risk for passive investors. It's a super high risk. Nobody knows what's going to happen in the next five years. If I'm getting cash flow today, that is low risk for me, right? Because I'm already making profit, right? But if the sponsor structure is return of capital, I'm not making any money for next 5 years, right? How if the market crash in the next in 5 years? That means you didn't make any money and you crash at the end.
Yes.
Right. Yes. And what has happened in that case, if you do your math correctly, let's say 80-20 return of capital, it's actually after 5 years, it becomes actually a 60-40 or 70-30 profit split. Because the amount of money being returned, your capital is being diluted, right? Let's say you have 100,000. Let's say after 5 years, you paid 10,000, so your remaining capital is only 50,000, correct? So at the end, when they split, they said, I'm going to return back your capital. So they're going to only give you back 50,000, but now the pie is bigger on the back end, right? So it's no more 80-20, it becomes like 60-40 or 70-30.
But not all operators do that. Some operators, even though they're doing return of capital, your investment doesn't get diluted. It stays.
Very, very few operators do this. Very, very few.
Okay.
Right? So that's the good part about it. But I know a big group of operators doing it.
That do it. Okay.
That do it.
Yeah, it usually goes by group, right? Some groups do it. It's not like you can't find the normal professional operators doing it because everybody will see it. But the problem is you get blindsided when you're in a group.
Got it.
Okay.
So everybody thinks the same.
Yes.
Oh, this group, everybody is the same. This is how the structure is.
Yes.
They get blindsided.